Good morning. Thank you for joining us for Capstone Coffee Conversations. My name is Ryan Stokestead, sitting along Brian Felshaw. And today we're going to talk about a couple topics that deal directly with your taxes. Everybody right now is probably compiling information and getting that to their accountants and CPAs. So taxes are definitely on top of mind. So we thought we'd hit on a couple subjects that aren't necessarily for last year's taxes. The things we'll talk about today won't help you for last year. They are topics that you can do throughout the year, usually towards the end of the year, that will help you for the current year's taxes and also help you for years and years forward and even passing to heirs. The strategies we're going to talk about today are what are called the Roth conversion and the realization of capital gains. I'm going to hit on the Roth conversion portion of the conversation, and Brian will be touching on the realization of capital gains.
Many of you know this, but we feel very passionately about the link between your tax advisor and your investment advisor. It's very important for them to work in concert with one another because what they each do affects one another and for your benefit. That's why we do tax work in-house most of the time if we can. Not to pat ourselves on the back too much either. I do feel that because of that tax presence in-house with Capstone, if you have a pre-existing tax relationship, we can often work with them very easily because we understand their language pretty darn well. So at the end of the day, a lot of this is, it's not what you make, it's what you keep as far as taxes go. And we're all about trying to help keep as much in your estate as possible at the end of the day.
Absolutely. So I'll hit on the topic of the Roth conversion. We'll discuss that first, and then I'll hand it back over to Brian. So a Roth conversion is the process of converting money from a traditional IRA into a Roth IRA. And they each have different rules, and they're each taxed differently, viewed by the IRS in a different manner. A traditional IRA, as you know, is fully taxable as you pull money out. If it's a pre-tax IRA, fully taxable as you pull withdrawals out, and also has what are called required minimum distributions. At the age of 72, if you have not taken your required minimum distribution yet, at the age of 72, you are now forced to take out a certain amount per year, and that continues through the rest of your life. If we want to convert money from a traditional IRA to a Roth IRA, we're able to move it sideways, kind of think of it right pocket to left pocket, one account to a different account. And in that process, we then pay tax at the current tax rate of whatever bracket you're in that year. So if we move money from a traditional to a Roth, the amount that we move, we would pay federal and possibly state tax in that conversion. The limits, you aren't limited like a contribution. You're able to move much higher amounts. You aren't kind of limited at a $6,000 or $7,000 a year amount like a contribution. In a conversion, you're able to move much larger amounts from your traditional IRA to your Roth IRA, again, paying tax on the amount that you convert in that year. One of the reasons to do that is going forward, if you convert from an IRA to a Roth, all growth going forward is now tax-free, as long as it's left in there for 5 years. So your traditional IRA, if you leave it in there and it grows and grows and grows, you kind of are growing a little bit more of a tax problem, as later on in life, if you're taking that money out, you're going to have to pay tax on potentially a higher amount. If you convert to a Roth and it is able to grow over time, that is tax-free growth that you're able to realize later. Also, on top of that, the money, based on which type of account it is in, passes to heirs in that same manner. So in other words, if I pass a traditional IRA onto my beneficiaries, they have 10 years to liquidate that account, and they'd have to pay tax on those liquidations because it's a traditional IRA. So their tax bracket then comes into place, but they have 10 years to take those funds out of a traditional IRA and pay tax on it. If you've converted it to a Roth, they still have 10 years to liquidate a Roth IRA, but now it's tax-free to them. So their tax bracket doesn't matter. There are some caveats, and I say the 10 years, that kind of is a catch-all bucket There might be some particulars where maybe it's a different age requirements for RMD, but for the most part, beneficiaries, if you have people you're passing them funds down to, have now 10 years to distribute. And if it's a traditional, fully taxable, and if you've converted to a Roth, fully tax-free.
So let's talk about capital gains for a few minutes. So capital gains tax is a hot button issue in the news cycle lately, but it's important to understand how it actually works and how it's actually on a separate tax bracket schedule from your ordinary income tax. So first off, what is a capital gain? Capital gain occurs when you sell an asset for a greater value than the level that you obtained it at. And that applies to investment property, precious metals that you have in a safe somewhere, classic cars maybe that have appreciated, any asset that's appreciating value that you sell, it's called realizing a gain, as opposed to if you hold something and now it's worth more than you paid for it, but you don't sell it, it's an unrealized gain. So sometimes we'll use that term, realized versus unrealized. There's also a difference between short-term capital gains and long-term capital gains. For most of you watching, this is going to apply to your brokerage accounts, whether they be joint for a couple or individual. Most of the time, that's going to be a stock or mutual fund or exchange traded fund, some kind of asset in your brokerage account. If you sell an asset or fund at a gain less than 12 months from the date that you purchased it, that's a short-term gain. Those are taxed at your regular ordinary income tax bracket levels that we'll get to in a few minutes. If you sell it at a date longer than 12 months from the date you purchased it, it's a long-term capital gain and it has a slightly more favorable tax treatment. So let's go ahead and look at those brackets and we'll go through an example. So if you can see those, we have different brackets based on different filing statuses. So the first one on the far left there is if you're a single filer and you have taxable income, so that's a combination of your regular income, let's say you have a pension of 20 grand, and then you have capital gains of 20 grand, and you have 40,000 of total taxable income, you're just under that 0% mark at 41,675. If you're married filing jointly couple, you get double that. If your income is under 83,000, you actually pay 0% capital gains tax. So when we talk about tax planning and maxing out your brackets, there is a concept of maxing out your capital gains bracket. So another example would be, let's say you have a $50,000 pension, you're a married filing joint couple, you have another 10,000 in Social Security, now you're at 60, and you have 30,000 of capital gains. We've had a good market in the last couple of years. Maybe you sell some positions that have grown quite a bit, and you want to de-risk and make those not be such a big part of your portfolio. And you have another 30,000. Now you're at 90,000 of gross income. You remove your deductions to get to your taxable income, which is on the sheet in front of you. Now you're under that 83, your capital gains will be taxed at 0%. So what we try to do as advisors when we work with your tax advisor, or if they're in-house here, we try to figure out, there could be a balance where you want to take some of your capital gains and do a Roth conversion. There is a balance between being able to max out what you can do at 0%, what you can do at 15%, which is the next bracket up in the capital gains tax brackets. So the left hand really has to know what the right hand is doing, because though capital gains tax is on a different schedule here, you can add to your income tax and end up bumping up your income tax bracket. So it's important that you work in concert on both of those items. There is a benefit, though, to deciding which you would want to do at what time in your life, and Ryan's going to talk a little bit more about that too. A lot of you might be entering retirement in sort of a sweet spot zone and need help deciding which is better to do for my future, capital gains tax or Roth conversion, or a mix of both, and that's what we help do.
Yeah, let's look at a couple examples of maybe when a Roth conversion would make sense. Just in theory, if you think about it, I think a Roth conversion can come into play when possibly I've been working, I've been earning money, I've been at a little bit of a higher bracket. Now I find myself, and maybe it's not just retirement, but in any time, maybe I find myself in a lower bracket than normal. Maybe I've retired, maybe I'm not working for a year, maybe I've had some losses somewhere else that I'm taking. If I find myself in a lower bracket than normal that I won't maybe stay at, it's a good year to do a Roth conversion, and you maximize that bracket to take advantage of a potential lower bracket. So a lot of times we see that, like I said, in folks who have maybe retired, they find themselves in a lower bracket, and maybe they aren't quite at required minimum distribution age yet, right? So at 72, we are forced to take money out of an IRA, pay tax on that. Sometimes there's a sweet spot between retirement and required minimum distribution age where our income's a little lower before the RMD, required distributions, might bump us back up again. We might have a sweet spot there where our income's a little lower. We can do some conversions and maximize a lower bracket and move money to a tax-free account, right? So let's look at a couple examples, and we'll pull up the 2022 tax tables and highlight just a couple places that we could see something like that. Okay, so first example, let's just say that you are a single filer. And if I go along, that's the first column on the left, the single filers. And let's say you're making 150,000. If you're at 150,000 taxable income, you would find yourself in the 24% bracket. That runs from 89,000 to about 170,000. Okay. Maybe I'm not taking RMDs, but in the future, I see myself having to take RMDs in the future that maybe I would then graduate to the 32% bracket later on, I can see in life, which would push me into a higher bracket. Well, if I know that's coming down the line, it would make sense to say, well, I'm at 150,000 today. The bracket stops at 170. I can stay in the 24% bracket if I do a conversion of $20,000 and not jump into that 32, because later in life, I'm going to be in the 32% bracket once required minimum distributions start. All right, so that's kind of maximizing I'm at 150, 170 is the peak of that bracket. I have room to move some money and stay at a low bracket, move it to a tax-free account. One other example, let's say we're a married couple and we have lower income, maybe we're mostly Social Security with pensions, but we have large IRAs. And if we're at 70,000 in taxable income, okay, married, filing jointly at 70,000 taxable income in that third column, we would find ourselves in the 12% bracket. And that bracket runs from 20 to almost 84, right? So that gives us about $14,000 of room to convert IRA and only pay 12% in federal tax. All right. So kind of looking at our brackets, where are we? And saying, what's the max I can take out and still stay in a lower bracket than I might find myself later is the practice of looking at, does a conversion to a Roth make sense for some dollars? One other thing to think about, a lot of assets in IRAs pass on to heirs. And if you know that you're passing some funds on to beneficiaries, looking at your tax bracket relative to their tax bracket can also make sense, right? So if I know my children are working, maybe they're at peak earning levels. If I pass on money to them, they have to pay tax at their rate. So if my rate is lower than my beneficiary's rates, it might make sense to do some Roth conversion so that when my beneficiaries inherit IRA assets, it's in a tax-free nature rather than at their tax bracket. So kind of paying the tax at my lower rate as a retiree, than my children paying it at a higher rate, maybe still working and earning at higher levels. Just a thought, doesn't obviously encompass everybody, but there are things to think about in that arena.
Can I add one thing to that too?
Absolutely.
So this does have a compounding effect. And if you think about, I pay the tax now on the Roth conversion, but if that Roth grows at 8 to 10% per year, on average over the next 10 years, how much more is there in that Roth now than the traditional IRA? And I do think of this in terms of of heirs or members of your family that maybe aren't at peak earning yet. Let's say they're in their 20s or 30s and they're not earning as much as they will in their 40s or 50s. They could do a Roth conversion at that point. Maybe it makes sense, maybe it doesn't. But that way, that money is now in the Roth for them going forward into their retirement and compounding over that period of time rather than compounding in their traditional IRA. So it may make sense for some of our younger clients as well.
For sure. Yeah.
Anything else there?
Nope, that's good.
So thank you for joining us. These are really important conversations to have throughout the year, as Ryan touched on. It's top of mind right now because it's February and we're all doing our taxes, and it's a good time to reflect on 2021. But we encourage you to take that information that you get from your 2021 tax return and apply it to 2022, and have tax projection meetings in the fall and in the summer and figure out what's the best way to take capital gains, do a Roth conversion if possible. But all it takes is a little bit of planning. So if there are any questions that you have, please type them into the chat directly to the host. We'll go ahead and answer them.
Yeah, we forgot to highlight that up front. And so, sorry, we'll give you a minute or two. Maybe I'll just ask a question because we didn't let you know. But yes, feel free to chat to the host. So I'll ask Brian a first question just to give people time if they want to. Roth conversions have been discussed on potentially being removed or not allowed going forward. You hear that as kind of a political posturing. Is that on the table? What are your thoughts there?
It's certainly been discussed. It hasn't been ruled out as of right now, but the trend that we sometimes see is as things get discussed in Congress, eventually they may happen down the line. What they've focused on is something called the backdoor Roth, and we can get into that. We can answer those questions about backdoor Roths at a different time. But they've first talked about getting rid of those to close that loophole, and they possibly discussed getting rid of all Roth conversions, but that has not happened as of yet. So as of right now, for 2021 tax returns, and then as you look at 2022, it's still open, still on the table to be able to do.
Yeah.
Someone asked, is there a limit amount for a Roth?
For conversion, go ahead.
For conversion, no. I think Ryan touched on that a little bit earlier. You can convert your entire IRA if you wanted to. It just you would pay possibly the most tax you could pay. It would depend on where your bracket is. Where the limits come into play is your contributions. And if you're under 50 years old, that's $6,000 per year. But a contribution is different than a conversion.
And then someone also asked, can heirs do sideways Roth movement of estate Roth IRA funds into the Roth, or does it have to leave an investment account?
Don't know if I understand that question. If somebody has an inherited Roth, call it if that's what we mean kind of by an estate Roth. If I inherit a Roth IRA today, there are rules now that I have to withdraw within 10 years if I inherit today going forward. So I could leave it in a Roth for 10 years in an inherited Roth account, but at that time, within 10 years, then it would have to be vacated. I could move that money to a investment account. I could use that money to make contributions maybe to an IRA or a Roth. So I can use that money to move it somewhere else in my financial picture, but it does have to vacate the inherited Roth IRA within 10 years. I hope that answers that question.
I think just to add on to my knowledge, you can't convert inherited IRA money to a Roth IRA because they're different types of accounts. You can certainly take your distributions and fund your Roth IRA, $6,000 a year, but because it's a different kind of account, you can't convert inherited IRA money to Roth IRA money.
However you inherit it has to stay in that type of an account.
Yeah.
Good. Well, thank you for joining us. We will see you again next month. Capstone Coffee Conversations run on the second Tuesday of every month. Topic will be announced in a few weeks, and we appreciate you being here. If you have any follow-up questions, feel free to email your advisor, your CPA. We'd love to hear from you. So thank you for being here.